Good afternoon, and thank you for joining us today. My name is Timothy Lee, and I'm a research analyst with Red Cloud Securities, and I'm delighted to host a Red Cloud webinar on iron ore and vanadium exploration and development today. We will hear from Sean Cleary, CEO and Chairman, and Scott Hicks, Executive VP of Corporate Development of Strategic Resources, Inc. During today's webinar, they will provide an overview and outlook. Then we will take questions. You can type your questions into the chat box at any time, and we will get to as many as we can. Before we kick things off, first we need to discuss some fine print. During the Strategic Resources webinar, forward-looking statements may be made. I would direct listeners to the company's forward-looking statements disclosure outlined on page 2 of the strategic corporate presentation, and that can be found on the company's website, strategic-res.com. For Red Cloud Securities, Inc., I would highlight that this webinar is for information purposes only. It should not be considered a solicitation or a recommendation to buy or sell securities. We note that this call does not consider the particular situation or needs of individual investors. Participants should rely on their own investigation and seek their own professional advice before investing. Please see our most recent research located on the Red Cloud website for specific disclosures pertaining to Strategic Resources. So we have Strategic Resources presenting today. The company is primarily focused on advancing its vertically integrated iron ore project in Quebec, including a large iron titanium vanadium deposit and downstream processing facilities. As well, the company has a past producing project in Finland. With that, I now turn it over to Sean and Scott to update our audience on the company.
Thanks. Good afternoon. Sean Cleary, Strategic Resources. We're focused on creating North American iron and metallics vanadium producer, advanced stage project in Quebec, and a past producer in Finland. And forward-looking statement. So, the way we're looking at the development of the Blackrock project in Quebec is that, really the first step is our pelletizing plant, which is to be built at a leased facility that we have the lease in place at Port Saguenay in Quebec. It's a deep sea port where it's a federal port owned by Ports Canada. And in partnership with the Quebec government, they've built an industrial park, which we've leased for the development first of the pellet plant, and then the balance over time of the metallurgical plant and the eventual integration of the open pit mine, which is located near Chibougamau in Quebec. Port Saguenay is a strategically located deep sea port on the east coast of Canada, full access into the St. Lawrence. It's open year round. The port itself can take up to small Cape-size vessels, and as small as Lakers. So we can load Lakers and ship down into the Great Lakes or out into the seaborne traffic to supply Gulf Coast, as well as Europe and as far away as Asia. The advantage, one of the significant advantages of the Port Saguenay port is not just its location, which is strategic in Quebec, but because Quebec is such a big hydroelectric producer, and the majority of power, virtually all of the power in the Saguenay region is hydroelectric, so it's very clean power. In addition to that, Port Saguenay has access to natural gas, and so this is much cleaner and greener in terms of a site location than the existing pellet plants in Quebec, which are located at Port Cartier and Septil and Pointe Noire, which you can see on your map there, which are being fed by iron-producing region of the Labrador Trough. We happen to be, close proximity to something like 70 million tons of iron ore production coming out of the Labrador Trough, as well as accessible to have iron ore feedstock fed into the Saguenay location. So the way we're looking at the project is to develop it in 3 phases. The first phase to be a 4 million ton pellet plant, which is currently underway. We've recently published a pre-feasibility study showing very robust economics on the pellet plant to be located at Port Saguenay. Phase 2 to expand into direct reduction and HBI production at Port Saguenay, and then phase 3 to integrate the process backwards to the open pit mine at Chibougamau, and to also produce 2 additional products of vanadium and titanium at Port Saguenay.
And Sean, maybe I'll add here and mention that phase 1, as Sean said, that's the study that came out 2 weeks ago here, and that could be built for about $500 million US. Phase 3 was, we had taken to kind of a full feasibility level when we took the company public and brought BlackRock public last year, basically. So we'll go through that as well today. But there's some different scenarios here that can play out and over time. So we have a lot of different growth options, and this is just kind of how we're currently thinking about phasing the capital.
So I guess, as a company, we're very much focused on the iron value chain, which you see on your screen here, starting with iron ore concentrate and then going all the way through to finished steel. And, this value chain it's important to understand that, iron ore concentrate trading around $100 a ton, pellets on the DR grade side sort of trading in the 170 range. DRI, HBI trading, close to scrap or just above scrap prices at about $500 a ton, up into the pig iron prices, trading as high as, $650 a ton, into finished steel, $850 to $1,000 a ton or more. So we're really focused on supplying what we call ore-based metallics to the steel market, especially in phase 1 of our project. And that's because there's been a significant change over the last number of years, moving the steel industry, moving away from blast furnace and BOFs to electric furnace, requiring much more scrap and much more ore-based metallics in the form of pig iron, HBI, DRI, and DR grade pellets.
Yeah, so Sean, maybe just to kind of put a punchline on that, is it fair to say that, iron ore concentrate can't be used in electric arc furnaces, so that's why you have to upgrade up this value chain?
That's it. And that's really the constraint on conversion of electric furnaces, much of which is going on today. And, the industry is expecting that just on the pellet side alone, probably a 40 to 50 million ton deficit per year in the pellet market starting in 2027. So that's why our focus is really on this high grade pellet part of the market.
Yeah, and I guess we're also hearing from people in the industry that in this scrap steel in the middle of this chart, there's going to be a deficit of good quality prime scrap going forward, which is going to force people to buy these kind of virgin iron metallic units to put into the electric arc furnaces.
100%. So it's a big opportunity. And, that's kind of the way we look at the value chain of the business. And when you drill down a little bit into, what's going on in the steel industry that are going to use these feedstocks to make steel, we know that, overall electric furnaces have a much lower carbon footprint than BOF and blast furnace, maybe, as 2/3 lower in terms of carbon emissions per ton of steel. And so that's very interesting to Western governments, which are focused on reducing, global greenhouse gas emissions and, focus on CO2 emissions from industry. And so if you look at Canada, Canada's invested now almost $1 billion from the federal government for the transition of blast furnaces to electric furnaces. especially focused in the Ontario market within the Great Lakes. In simple terms, a blast furnace might use 25% of scrap in its steel making recipe in terms of what's going into the furnace itself, whereas an electric furnace could use typically 75% of its recipe could be scrap. So you see, there's going to be a big pull on scrap, and especially what we call prime scrap in the market. And so is there enough prime scrap to go around? That's a question. And as the industry has to use lower grades of scrap, they have to use more what Scott referred to as virgin iron units. That's so that they can dilute out any contaminants contained in the scrap to hit the steel spec that is required. And really the solution for that is pig iron, HBI, DRI, and all of which is fed by DR grade pellets. So, and that's why we're started and focused on DR grade pellets. And our overall project is focused all the way to high purity pig iron. And just on the met tests that have been done on pig iron for our overall project, it shows that this is going to be one of the highest purity forms of the product out there. The gold standard in the industry is Rio Tinto, a product called Sorel Metal, and all of our met tests show that we'll be sort of at, near, or above the standards of a Sorel type grade. So the industry is very interested in what this project is and where it's going. A lot of demand, America, Japan, Europe, to go fully electric, and they need these materials. And overall, this is, a very, very significant shift in material flows for the steel industry, because the industry expects that by 2050, something like 50% of steel globally will be made by electric furnaces. So you're talking about something like a change in magnitude of material flows, in the order of, up to 1 billion tons per year overall over the next decades. So us starting with 4 million tons a year, pellet plant at Port Saguenay with excellent, economic forecasts coming out of the engineering study, it's really a great first step.
So maybe just talking quickly about the market here, and we won't spend a ton of time on this slide, but in general, we think there's going to be a big pull on need for pellets. You can see on the right-hand graph, that's kind of been the DR grade premium over, the last, call it 7 years. We've hit a high of $110. And, if you take out COVID, I'd say it's kind of been between, $50 to $70 on average. And, you'll see in our study here, we assume 70 in our study. We think this trends up over time because of all the dynamics Sean just talked about.
Yeah, and so just a little bit more on the location at Port Saguenay in Quebec. As I mentioned, this is a Ports Canada port, so it's a public port. The port and the government and the local municipality have built out an industrial park that's located basically up the hill, and you can see on the photograph from the wharf, it's up the hill, and then the other photograph that you see there is the industrial park itself looking down to the wharf. The government itself is very involved in the development of the industrial park, as well as certain infrastructure around the port for the development of this industrial park, as well as directly involved in helping with that infrastructure, and have also a very significant investment in strategic resources. So today we've taken out a long-term lease on a large part of the industrial park at the wharf. So that's for the overall project, and that lease is now in place. And in December, the government's announced that funding for $111 million conveyor system from the wharf to essentially where the building is in that picture at the industrial park. And that's to deliver pellet feed from the wharf up to the pellet plant, and then we'll be able to use that conveyor to ship the pellets down to the wharf for shipment and export out to market. So, that's a very important announcement and funding from the government that's really kickstarting this project. Overall, I would say that this port is, currently running at maybe about 25% of capacity utilization in terms of the wharf. So there's a lot of room here for growth over time. The port executive have been super supportive of our project and the overall development of the Port Saguenay area, including developing this industrial park, but also expropriating additional lands in the area so that the industrial park can grow, as well as tying in recently the rail spurs coming right into the industrial park. So, it's a great location, and it's an area where we can ship not just down into the Great Lakes, but out into the Atlantic as well.
So maybe just kind of running through the high level numbers on the study here, the PFS we put out a couple of weeks ago. Basically, we looked at what would it cost to install a 4 million ton pelletizer that we would run on a merchant basis. So again, this is other mines feeds coming into the port, going up that conveyor Sean just talked about that's being constructed right now into the pelletizer. So basically, it's about $470 million US to build that project, the larger pelletizer, versus what we had imagined before in our basically integrated plan. And really, it's going to be about $16 a ton to convert that iron ore into pellets, which is pretty competitive. There's a lot of advantages, obviously, to this site. The existing infrastructure, access to natural gas, as Sean mentioned, which is important, not only for emissions, but also for operating costs. And then obviously Quebec has relatively cheap power in the global scheme, and it's basically first quartile. So you're going to have a very low cost operation here that, can withstand basically fluctuations in the pellet premium, although we do expect it, as I said earlier, to trend upward. So you can see here kind of the NPV of the project is about $1 billion US at about a 25% after-tax IRR, and we expect it to throw off about $175 million of steady state EBITDA every year. And in the model, we assumed a 50-year project life with about 2.5 years to construct the project. So, we think this is a great way to phase the capital versus if you looked at our old feasibility study, which we'll walk you through quickly, that was about $1.5 billion of Canadian capital. So this is obviously a much smaller way to start and very financeable, we think, with the amount of EBITDA and margin that this project will throw off. And, maybe I'll just carry on here with the current cap structure of the company. So it's about 59 million shares outstanding. It's a very tightly held company. Our largest shareholders are the Quebec government through Investissement Quebec, who manages that investment for them. It's 41% holding. We also have Orion Mine Finance out of New York, who's holding 41%. The Lumina Group, who I work with, and Ross Beatty hold 4.5% of the company. The Cree, which is the indigenous group around our mine site in Chibougamau, hold just under 3%. And Orion Resources, which is a Finnish gold explorer, holds 2.3%. And then management and the board have 0.7%. I'm in the Lumina Group bucket on this chart. Sean's in the 0.7% there. And then you've got a free float of about 9% on the stock. So it's fairly tightly held. Today, we're trading around $1 a share, so call it a $60 million Canadian market cap, about 4 million Canadian on the balance sheet right now. Obviously, we're out there trying to secure two things, really. The offtake to secure feed going into this plant, and then the financing plan to drive the construction of the $500 million project going forward. We do expect Quebec and Orion to be a large part of that financing package. We're also looking at project debt and some other options to bring in the capital that is required to build phase one, as we're calling it here. So in summary, that's kind of phase one. As we see it going forward, there's a lot of different options to grow this company. We have two excellent resource bases globally, and other plans at the metallurgical facility. I'll hand it back to Sean here to talk about what building out the mine would look like and some of the elements that were imagined under the old feasibility study for the larger project.
Thanks, Scott. That was a picture of the deposit outcropping, I guess, up in Chibougamau. This slide is, really focusing in on the high purity pig iron market. And that's going to be the major overall product for the integrated project by the time we get through phase 3. And, high purity pig iron is an important input for foundries and steel production, and really supporting that transition to electric arc furnaces that I talked a little bit about before. In addition to the high purity pig iron that we would produce, we would also be producing a product of vanadium, which is considered a critical mineral in Canada, the United States, and Europe, as well as a byproduct of titanium. And the vanadium, it's used in steel making for making lighter, stronger steels, very important for the automotive and structural steel industries, as well as for vanadium flow batteries, which are used for long life grid scale batteries. So this is really also a battery metal. And we have the two large projects, which Scott mentioned, obviously the Blackrock project in Quebec and the Mustavären mine, which is a former producer in Finland, both very similar type large scale projects. On the overall project for Blackrock, we did a full feasibility in November 2022, showing after-tax NPV at 8% of just under 2 billion Canadian dollars. First quartile on the cost curve for all three products. It's a 39-year mine life at Chibougamau, and that's not including, we've done drilling on a potential second pit, which may have as much as 30 years of mine life. And that also excludes the assets that we have in Finland. The Blackrock project, in terms of the open pit mine, the concentrator to be located at Chibougamau, as well as the full metallurgical plant at Port Saguenay, that's fully permitted and basically ready for construction. And as Scott mentioned, we're well sponsored in terms of backing from Quebec government. We're well supported at the port through Ports Canada. And in terms of shareholders, Orion Mine Finance, Ross Beatty, Lumina Group, Cree Nation, these are all, very, very significant sponsors of the company and the project. So we have done extensive engineering on the direct reduction portion of the project for the production eventually of DRI and pig iron. And Tenova, which is the OEM, one of the largest in the world in terms of direct reduction furnaces, their process uses natural gas in order to reduce the iron. That's part of the metallurgical process. Can also use hydrogen, so it's green hydrogen ready. And so we've been looking at a number of different avenues on the hydrogen side, which we'll talk about in a minute. But basically, Tenova has come out publicly and said, like, once this plant is built, it will be the greenest pig iron plant in the world. And then in terms of where we're going to take it from, the small green CO2 footprint that it will have initially, down to our plan is to get it to carbon neutral, to zero carbon over time. We're looking at a mix of technologies that would allow us to do that using hydrogen and the production of hydrogen. So we've announced collaboration agreements with Cipher Neutron, which is an electrolyzer producer and technology company, a Canadian company. So we'll use a portion of electricity and water to produce hydrogen that can go into our system. Safer Neutron's technology is modular, so we can grow that over time. And same for Levidian. So we've also announced a collaboration agreement with Levidian, which is a British company from the UK. And they have a technology that in terms of reforming natural gas, so this would assist us in reforming natural gas into hydrogen, which would reduce our overall footprint. And interestingly enough, also produce a byproduct of graphene, which we could sell. So that would be an additional revenue stream from the company, or an offset against the cost of hydrogen production on site. And again, like Safer Neutron, Levidian's technology is modular, so we could start quite small, and then over time, as the cost, as costs of hydrogen come down and the inputs come down, we could build up to somewhere around 70% hydrogen to 30% natural gas over time, which would take our carbon footprint down to like near zero. And so, on the screen, you see the schematic map of Quebec in the top right. So Chibougamau, mining town, middle of the province, sort of the jumping off point for northern exploration and development within the province of Quebec. So in Chibougamau, you have everything. It's a great location, major airport for the north. It's connected by highway to the rest of the province, as well as rail. Where project is located is just south of Chibougamau, and less than 1 hour's drive right onto the property, fully accessible. The idea is to build an open pit mine, as I mentioned, and have a concentrator on site. So we would produce concentrate about 1 million tons a year of what we call VTM concentrate. That's 62% iron, 1.4% vanadium, and about 9% titanium. And that would go initially by truck to a rail loading station. The red lines on the map are the rail infrastructure of Quebec. So we have rail located. CN Rail is about 26 kilometers from where the concentrator would be located. So we would truck the 26 kilometers initially, and then load trains and take those down to Port Saguenay to produce. From 1 million tons of VTM concentrate, we would produce about 526,000 tons of high purity pig iron, about 4,400 tons of V in terms of ferrovanadium, and about 118,000 tons of commercial titanium slag. So those would be the three products. Zooming in on the deposit itself at Chibougamau, so we have about roughly 20 kilometers of strike outcropping, kind of throughout. So this is very low overburden. It's the high area in terms topographically, the high area of the James Bay Territory. It's actually the watershed of the James Bay Territory is this deposit. And we've drilled off 2 pits. The first pit, as I mentioned, has a 39-year mine life. At run of mine is 3 million tons of ore per year to produce about 1 million tons of concentrate per year. It's very clean. The concentrator itself is a simple crush grind magnetic separation, no flotation required to produce this very, very high quality world-class concentrate. And here you see the process flow for the mine and concentrator in the box at the top called Chibougamau mine site. So crush grind magnetic separation to produce that concentrate, taken by initially by truck to the railhead and then by rail. It's about 400 kilometers down to the port at Saguenay. We would have a car dumper at the metallurgical plant, the pelletizer, which we've talked a little bit about, DRI furnace, and an electric furnace, which they call an open slag bath furnace, OSBF type furnace, to be able to take off the titanium. Then the hot metal goes into a converter furnace, We blow oxygen into the converter furnace to produce a vanadium slag, and we're left with high purity pig iron, which we cast, and that goes to market.
And I think it's important to kind of point out a couple of things here. Everything you guys see on this page is fully permitted. The pelletizer that is part of this flow sheet was originally imagined at 1 million tons a year to match the mine concentrate output. That's the component that we have upsized to 4 million tons for what we're calling phase one, and the pelletizer that we already walked you guys through and the economics from the PFS on that. So phase one is just the bottom left of the page here, the balling induration fired pellets. Phase two that we started the presentation with, talking about doing DRI and HBI, is this HYL energeron direct reduction. And then the rest of the flow sheet is really there to handle taking off the vanadium and titanium that's specific to Blackrock's deposit, and also the deposit we have in Finland. So as you can see, there's lots of components to this, but this is all conventional technology, and this is all permitted as we stand right now. So maybe I'll quickly walk through the feasibility study here, and then I appreciate we're probably running a bit long on time, so we'll open it up for Q&A. But it is important to realize that under the old feasibility study, it was a very profitable, high margin operation. It was a large capital operation of 1.5 billion Canadian, and that's part of why our shareholders and management have moved towards this phased approach that we starting with the larger pelletizer. But this project in and of itself was going to throw off about $500 million of EBITDA Canadian a year, at about an 18% IRR. And obviously, vanadium and titanium are critical metals, and they're going to be very important for decarbonization moving forward. So, this is still a very important mine site and a very important project to the company. It's just probably going to come in later now as we get the pelletizer up and running, and that's going to be our focus in the near term. So maybe with that, Tim, I'll pause there, and we could take some Q&A if people have questions.
That sounds great. Thank you very much, Sean and Scott, for the informative presentation. As Scott mentioned, we'll now start the Q&A portion of the webinar. A reminder to everyone on the line that you can type your questions into the chat box at any time. We already do have a few questions. One, congratulations on your final engineering plan for the site at the port. Is the project fully funded? Or I would follow up, what project finance options are you looking at?
Sure. So, our first step here, I think, ahead of the project finance is going to be securing feed and securing the stock that's coming into the plant. We do have multiple project finance banks looking at the debt piece for this right now. As I mentioned earlier, it's about $175 million of EBITDA a year. So, we think that this project could easily support kind of at least 50% debt. So call it, $250 million of the round number, $500 million financing. And then, we'll look to Investissement Quebec and the Quebec government, as well as Orion, and some other outside capital sources to piece together the rest of the equity for that.
Great. And looking forward at the timing here, do you have an ETA for when you'd start building the project?
Yeah, so we're trying to secure feed in the next, call it by the end of Q2 is our kind of internal goal, and then project financing by year end so that we could break ground in 2025. That's our plan right now.
Okay, great. Now you had mentioned that the iron plant would be likely the greenest in the world. Do you expect the hydroelectric power sources to provide some sort of green premium to the final products? And to that extent, has the company considered a value in use to quantify a potential premium?
Well, from a high level, we haven't really built that into our financial models. We do think that, on a comparative basis, when we just talk about the pellet project, the 4 million ton pellet project. So the pellets that we could produce at Saguenay will have a lower carbon footprint than other pellets that are produced in Canada. So we believe it will have the lowest footprint. And there's a lot of interest in that, especially out of Europe, because of the carbon border adjustment and what's coming in terms of incentives and disincentives for high carbon products in the European market. So that's a real change within the material flows for the steel industry. And we do anticipate that a large value in use could be attained for this type of product. But I think we've been generally conservative in terms of how we've thought about that within our financial model. And Scott, maybe you want to, add some detail around that.
Yeah, I mean, we, similar to, I think, other people who are pursuing the green steel path here, we do think we will get a premium for that product. I also think, maybe we didn't spend that much time on in the presentation, but the permits we have in the context of Quebec are very valuable. I think it will be harder for people in the north to get, whether it's new permits for pelletizing or expansions put through permitting process, just with emissions and the way the world's going right now. So we think it's all kind of wind at our back in multiple directions.
Yeah. And I guess that one of the major reasons for that is that, natural gas in Quebec supplies to Port Saguenay, but north of Port Saguenay, there are no pipelines. So, the traditional iron producing region of Eastern Canada, being the Labrador Trough, does not have access to natural gas. And that's really the key differentiator for producing low emission pellets.
Okay, great. Circling back to the project finance, we have a question following up. Have you appointed any advisors to help with the financing?
We have some people who are helping us on the equity and potential partnership avenues, I'd say. Obviously, aside from conventional debt and conventional equity, we're also looking at whether it makes sense to partner with end users on the project or producers of iron concentrate now. So there's some advisors helping us on those type of discussions. We haven't appointed a project finance bank formally on the debt, but we'd be hoping to do so in the near term.
Okay, great. One question here: Would your iron ore pellets and pig iron products benefit from, protectionist measures in Canada or North America in general?
Oh, I see. Like from the context of M&A from a foreign source, is that where the question's going, Tim?
I'm not sure exactly if it's more M&A or if it's about tariffs or things around the steel industry.
Yeah, so I guess American policy has gotten more protectionist around steel and steel dumping into the U.S. market. So the products that we're looking, that Strategic Resources is looking to produce, are not captured by any of those protectionist tariffs that have been implemented in the United States. And in fact, the U.S. as it continues to build out its electric furnace steelmaking operations, is going to need more and more virgin iron units. So there's lots of discussion with American firms on securing ore-based metallics, on securing scrap supplies. You already see in the United States some of the big electric arc furnace steel producers like Nucor and Steel Dynamics, for example, have gone out and purchased scrap yards, scrap businesses, scrap traders, et cetera, because, of concern on their part for making sure that they have security of supply. And I think to a lesser extent on ore-based metallics, although Nucor does have investments in DRI production facilities, in Louisiana and in fact in Trinidad as well. But this is a big topic of discussion. Like if you go to any steel conference, this is what they're talking about. They're talking about those ore-based metallics, the scrap supply, security of supply, the transition to electric furnaces. This is the theme of the industry, and it's going to be the theme of the industry for the next 20 years.
Okay. And one kind of general question here. Can you tell us a bit more about the arrangement with the port of Saguenay and how your project fits within the greater plan there?
Sure. Look, Port Saguenay, federally owned port, so it's a public port. It's governed by federal government of Canada. They have a large what they call the port lands there. So they have the wharf. They have expansion plans for their wharf. So what we understand is that there may be an additional wharf added at Port Saguenay over time, perhaps 2 wharfs added over time, depending on how the speed at which the industrial park develops. So in terms of, in addition to the wharf, they have, as I mentioned, what they call the port lands. So they've actually built out the industrial park pad and tied the rail into that infrastructure, as well as they have designs and thoughts and have expropriated land for additional lots that they would add on to the industrial park. I would say that the Blackrock project at Port Saguenay is a very, very important project to the port itself. Major reason for the development of the conveyor belt from the wharf to the industrial park, as well as a lot of related infrastructure in and around Saguenay having to do with processed water, the expansion of different hydroelectric lines, as well as tying in the natural gas infrastructure into the port. It's all going to help the development of the port lands at Port Saguenay. Overall, there is also a theme at Port Saguenay for the development of battery-related industries. The vanadium portion of our project ties in very well in terms of the strategic tie-in to what the governments and the port itself, the port management, want to do in terms of attracting additional projects to Port Saguenay. Today at the industrial park, Blackrock is the only leased part of, so we have the first lease at the industrial park, and the other portions of the industrial park, the way we understand it, have not yet been leased. So more to come on that.
Okay, great. One question I would ask here, just out of curiosity a bit, obviously your deposit is a bit different from the typical iron ore deposit out there that might be a banded iron formation. Would your pellet plant and pig iron plant be built to accept either ore as far as the feed, or would there need to be any retrofitting once you start feeding from your own deposit?
Yeah, that's a great question, Tim. I think the simple answer is yes, it's interchangeable, but you also have to be concerned about the potential of cross-contamination from the VTM ore to a straight iron ore within the plant. So we would have to work out a standard, an SOP, to be able to handle that within the plant itself. And it also depends on the demand from our perspective, the demand side of what's going on for DR pellets. So if we're able to eventually further expand the pellet operations at Port Saguenay, we may end up with a separate line that is fully designated towards the VTM concentrate, and a separate line that's fully designated towards pure iron ore concentrate. That part of the project would be an expansion. It's not permitted today. So we'd have to look at that, and it's really going to be market driven from the way I look at it. But the simple answer is yes, but it's not a simple answer.
Okay, sure. Great. Well, I think that's all the questions we had. I guess one other follow-up question. What are the plans for the project in Finland? Obviously, you're focused primarily in Quebec. Do you need to do work in Finland to maintain rights there and so on? Or I guess, what are the plans there?
Yeah, it's a good question. It's a partially permanent project. It was a past producer. The holding costs are extremely low. If as part of the environmental permit and maintaining that, we do need to start doing some baseline monitoring next year and the year after in that area. Obviously, if we do build out what Sean was just talking about, what we're calling phase 3, that con is almost identical to Blackrock. It's a little bit higher VTM. It's very similar iron grade. It's very similar titanium grade. So that could come over for processing. We're also looking at different options as to whether there's a smarter way to get that into production sooner. So, it's a valuable resource. Certainly not getting any value for it in the company today. And it's a pretty cheap option to hold.
Yeah, and I would just add to that it's recently been identified by the EU government as one of 2 sites within Europe as a strategic vanadium site. And so, there's been some studies announced that are being funded by the government, because as a region, as a government, the European Union is concerned about security of supply when it comes to vanadium. A lot of their vanadium has been, over the past, number of years, sourced out of Russia and, to a lesser extent, South Africa, both of which are becoming, more problematic as regions of supply. So, there is an increased emphasis on trying to do more development within the European Union itself.
Okay, great. Well, I guess just to review, obviously you have mentioned over the course of the presentation, but to kind of finish off here, what catalysts or news items might we expect from Strategic Resources in the coming months?
Yeah, I think securing the offtake will hopefully be the next one off the line for us. And then, stay tuned for financing updates and financing news going forward. And then the off chance that we do something smart on the corporate development side. We thanks everybody for listening today. I know it's a different story than what you'd usually hear, but we do really believe in both the green steel space going forward and the vanadium space going forward. And we think we have excellent backers to hopefully get this across the line.
Great. Well, I'd like to thank Sean Cleary and Scott Hicks for presenting today. And thank you everyone on the line for tuning in. Just a reminder that Red Cloud Securities will be back next week when our webinar series continues with Ucore Rare Metals presenting Wednesday, April 3rd at 2 p.m. Eastern Time. Have a great rest of your day.